If you hold silver, stop scrolling, because what you are about to hear could completely change how you see the next move in the markets, as a respected momentum analyst is warning that silver is approaching a level where history shows it does not crawl forward, it explodes. And once that move starts, the window to react closes faster than most people expect. Silver has always been the quiet metal, sitting in the shadow of gold, ignored until the moment it suddenly isn't, and that pattern has repeated for more than a century. Michael Oliver, known for focusing not on opinions but on long-term momentum structures, has been issuing a clear warning that silver is nearing a structural inflection point. To understand why this matters, you have to step back and forget the daily price noise, the headlines about short-term demand, and even the usual stories about inflation. Momentum analysis looks at markets the way an engineer looks at a bridge, asking not how it looks today, but how much stress it can handle before it snaps or launches higher. According to this approach, silver has spent years building pressure, coiling like a spring that has been compressed again and again without being allowed to fully release. Historically, when silver finally resolves that kind of compression, the move is not polite or gradual. It is fast, emotional, and often shocking even to people who already own it. Think about previous silver cycles. In the late 1970s, silver spent years trading sideways while inflation quietly eroded purchasing power and confidence in fiat currencies weakened. Then, almost suddenly, silver went from being considered boring to becoming the center of global attention, multiplying several times over in a short period. The same thing happened again in the early 2000s. Silver lagged gold for years, frustrating investors, until momentum shifted and it began to outperform dramatically. What Michael Oliver's work highlights is that silver tends to move in long periods of dormancy followed by violent repricing. These are not random events. They occur when long-term momentum breaks above levels that have capped price for years or even decades. One of the most important concepts here is relative strength, not just whether silver is rising in dollar terms, but whether it is gaining strength compared to other assets like gold, equities, or even bonds. Oliver has repeatedly pointed out that when silver's momentum turns positive relative to gold, it signals a change in leadership within the precious metal space. Gold often moves first, acting as the signal flare that something is wrong in the broader financial system. Silver follows later, but when it does, it tends to move harder because it is smaller, thinner, and more emotionally driven. This is why silver is sometimes called the poor man's gold, not because it is inferior, but because it attracts a different type of participant once the move begins, creating feedback loops of demand, fear, and speculation. Another layer to this warning involves how silver behaves during periods of stress in the monetary system. Unlike gold, silver is both a monetary metal and an industrial metal. It is used in electronics, solar panels, medical equipment, and emerging technologies that require conductivity and reliability. This creates a unique dynamic. During economic slowdowns, industrial demand can soften, which is often used as an argument against silver. But during monetary stress, when currencies lose credibility and investors look for tangible stores of value, silver benefits from both investment demand and supply constraints. Above-ground silver inventories are far smaller than most people assume, especially when compared to paper claims, futures contracts, and derivatives tied to silver prices. This mismatch between physical availability and paper exposure is one of the reasons silver moves can become disorderly. Michael Oliver's warning is not about predicting a specific date or price target. It is about identifying when a market is structurally set up for a major change in behavior. He focuses on momentum breakouts that, once achieved, tend to invalidate bearish narratives that have dominated for years. For silver, that means a decisive move above long term. Momentum ceilings that have held since the last major cycle. When those levels are breached, history suggests that pullbacks become shallow, volatility increases, and public interest returns very quickly. This is usually the phase where people who ignored silver for years suddenly ask if it is too late, even though the biggest part of the move may still be ahead. It is also important to understand why silver often feels manipulated or suppressed to holders. Silver trades in a market where paper contracts can represent multiples of annual mine supply. This creates periods where price appears disconnected from physical fundamentals. However, momentum analysis cuts through that noise by focusing on the end result rather than the daily mechanics. No matter how complex the market structure is, price ultimately reflects pressure. When momentum turns, it suggests that the forces keeping price contained are weakening. This does not mean manipulation disappears overnight, but it does mean it becomes less effective, like trying to hold a beach ball underwater as it pushes harder and harder toward the surface. For someone holding silver, this warning changes the psychological framework. Instead of asking why silver is not moving yet, the more important question becomes, what happens if it does? Are you positioned for volatility, not just upside but sharp swings that test conviction? Silver rallies are rarely smooth. They are emotional, often shaking out weak hands before accelerating. Understanding this in advance can be the difference between benefiting from a major move and exiting too early because of fear or frustration. At the same time, this is not a call to blind optimism. Momentum can fail and markets can always surprise. But when analysts who specialize in long-term structural signals raise cautionary flags, it is usually because something significant is changing beneath the surface. Silver does not need perfect economic conditions to move. In fact, it often performs best when conditions are confusing, when inflation, debt, and confidence in policy collide. That is why this moment is so important to understand, because if silver's momentum confirms what is being warned about, the narrative around it could shift rapidly, pulling in attention from investors who have ignored it for years and creating the kind of move that rewrites expectations now. Now consider what happens when silver's momentum signal actually confirms, because this is where Michael Oliver's warning shifts from theory into real-world consequences for investors, markets, and even everyday purchasing power. When momentum breaks, it does not ask for permission from headlines or central banks. It simply reprices the asset to a level that better reflects accumulated pressure. In silver's case, that pressure has been building through years of monetary expansion, rising sovereign debt, and repeated confidence shocks that never fully resolve. Think of it like a fault line that has not reduced a major earthquake in decades. Small tremors happen all the time, but the longer the fault stays locked, the more powerful the eventual release tends to be. One reason this moment matters so much is the broader macro backdrop. Global debt levels are higher today than at any other point in modern history, not just in absolute terms, but relative to economic output. Governments have become structurally dependent on low interest rates to service that debt, which limits how aggressively central banks can fight inflation without destabilizing financial systems. This creates a slow-burning erosion of currency value, even when official inflation numbers appear to cool. Silver, historically, responds not just to inflation itself, but to the realization that inflation is embedded and difficult to escape. That realization often arrives suddenly, and when it does, investors look for assets that cannot be printed, diluted, or politically negotiated away. Michael Oliver's work emphasizes that silver's long-term momentum base has been forming during a period when many people lost patience with it. This is not accidental. Markets often wear participants down emotionally before making a decisive move. Holding an asset that does nothing for years while other assets appear to soar creates doubt and regret. That emotional exhaustion is part of the setup. When momentum finally turns, many former holders are gone and new buyers rush in at higher prices, creating a sharp imbalance between on-demand and available supply. This is one reason silver rallies tend to overshoot what fundamentals alone would justify. Another key aspect is silver's relationship with gold. Gold often acts as the steady signal, while silver acts as the amplifier. When gold breaks into a new uptrend, it validates concerns about currency stability and financial risk. Silver then follows, but because its market is smaller and more volatile, it tends to move faster and further in percentage terms. Oliver has pointed out that silver does not need gold to skyrocket for it to perform exceptionally well. It simply needs gold to stop falling and stabilize, while silver's own momentum structure turns positive. That subtle shift is often missed by casual observers who assume silver only moves when gold is already making headlines. Industrial demand adds another layer of complexity. Silver is a critical input for technologies tied to energy transition, electronics, and medical applications. Unlike many industrial metals, silver is often consumed rather than recycled, meaning it is removed from the above-ground supply permanently. Over time, this creates a quiet drain on available physical silver, even if mine supply appears stable. When investment demand rises on top of this baseline industrial demand, the market can tighten much faster than expected. This is where paper markets and physical reality can diverge in dramatic ways. Paper silver markets allow large volumes of trading without requiring physical delivery. Under normal conditions, this works smoothly, but during periods of rising demand for physical ownership, cracks can appear. Premiums on coins and bars can rise even if the spot price lags, signaling stress beneath the surface. Momentum analysis does not directly measure these mechanics, but it often captures their effect indirectly as price behavior changes in response to underlying pressure. When Oliver talks about momentum ceilings being breached, He is essentially describing the point where the market's ability to absorb demand without repricing fails. For long-term holders, this environment reframes risk. The biggest risk may no longer be short-term price fluctuations, but being underexposed to an asset that is structurally positioned for repricing. Silver's volatility can be intimidating, but volatility is not inherently negative. It is the price of admission for assets that move quickly when conditions align. Historically, silver's largest gains have occurred in relatively short windows, surrounded by long periods of stagnation. Missing those windows can mean missing most of the cycle's returns. It is also worth addressing skepticism, because silver has disappointed many people before. Promises of imminent breakouts have come and gone. The difference highlighted by momentum-based analysis is that it does not rely on stories or catalysts. It relies on how the market itself behaves over time. When momentum remains suppressed, warnings are quiet or absent. When momentum approaches critical thresholds, the warnings become more urgent. This is why Oliver's latest commentary has drawn attention. It suggests that silver is not just cheap or undervalued, but structurally ready to change character. Imagine standing at the edge of a dam that has held back water for years. Small leaks appear, then stop. Pressure continues to build behind the wall. At some point, either the dam is reinforced or the water finds a way through. Markets behave similarly. Silver's long consolidation is not proof of weakness, it may be evidence of strength being restrained. When that restraint fails, the adjustment can be swift and emotionally charged. For viewers trying to decide what this means personally, the key is preparation rather than prediction. Understanding silver's nature, its historical behavior, and its role in a diversified strategy matters more than guessing exact prices. Silver is not a get-rich-quick asset, but when it moves, it can reset expectations very quickly. That is the essence of the warning being discussed. It is not about hype, but about recognizing when a long-suppressed asset is nearing a point where the rules change, and once they do, the conversation around silver will not sound the same again.